Hello and welcome to Money News on Newsmax TV. I'm John Bachman. Joining us right now from New York City is David McAlvany, CEO of the McAlvany Financial Companies. David, it's good to see you again.
Good to be back with you.
It looks like we could see another spring and summer swoon with the recent reports backing up that hypothesis. Housing numbers have seem to be might be actually cooling off a bit, with home starts way down from last month, and jobless claims are up again month to month. Let's focus on the housing at first. Is this recent dip in home starts a sign of deeper troubles ahead, or do you think that there is still enough positive momentum in the housing sector to help buoy the U.S. economy?
John, great questions. I'm trying to remember if it was our last conversation where we talked about seasonal adjustments being fairly positive in the first half of the year, most of those coming in the first quarter, with negative seasonal adjustments being more common in the last half of the year. I think the challenge for investors is to realize that the good news comes early and is usually overstated. It's too positive. And the bad news comes late in the year, and it's overstated as well. Again, these sort of seasonal biases. So I think that's what we're moving into, and that notion of sort of sell in May and go away is because, again, classically, you've had these seasonal adjustments early on in the year, lots of positive press to reinforce investor sentiment coming into the market. But then when you get to the second half of the year, it's negative news followed by more negative news, followed by more negative news, and there's really no positive traction gained in the equities market.
And when you hear people talking about real estate as I'm sorry, go ahead.
Well, the real estate market is a fascinating piece because, we've had a massive overhang of inventory. A lot of that has been eliminated by institutional investors and private equity firms, and that has made the market a much healthier place. And having said that, and this goes back to something that we had mentioned relating to the Japanese need to see incomes rise along with sort of this inflation factor that they're dealing with. We, too, need to see incomes rise. We need to see a return to the jobs market, and we need to see an increase in incomes. And right now, John, we're dealing with incomes that are on par with 1995. If you adjust for inflation, U.S. average median income is about where it was in 1995. Well, I can tell you, there's not a thing that you can purchase in my world, and perhaps in yours too,
sure, that
costs the same as what it did in 1995. So this is what you need for a sustainable recovery in real estate is an increased number of people getting back to work, not just people falling off the rolls. That's a lame way of looking at an improvement in the jobs numbers. Moving from 10% down to 7.5, there's some shenanigans that are played as that statistic is put together. Some faulty the statistical games played. But again, a return to jobs and an increase in income, those things would set the housing market on fire. Without them, the best you have is a floor being put in temporarily by investors who've been willing to take excess supply off the market. What would be that next shoe to drop in real estate? If we were to see a second decline, it would be on the basis of an increase in interest rates. We don't have that yet today. So the best you can say is we've had stabilization in real estate. Real growth would be because of the two factors we talked about, and a significant decline would be an increase in the cost of capital. Interest rates move higher. Home prices, just like the bond market, they behave similarly, are going lower.
Yeah, and in real estate specifically, it's still such a segmented market. Different trends are happening in different markets, so you got to really be careful if you're going to try to go with a real estate investment. Let's talk about gold a little bit. It's been on the slide, and it could be headed for its longest decline in a few years. I'm seeing more and more analysts say that there's a big problem with gold right now, and that's that you can't do anything with it. So if I'm holding gold or a lot of gold stocks, is it time to cut bait?
No, John, I think it's probably time to double down. Particularly on the physical metals, I think we may have further weakness in the shares. But again, this is an appetite that needs to be fed, not squashed. If you thought that it made sense to own gold at 15 or 16 or 1700, just remember that the fundamentals haven't changed at all. And this is the realities we deal with today. We've had central bank balance sheet expansion of over $9 trillion in the context of this crisis. That would buy a flat screen television for every man, woman, and child on the planet. Okay, I mean the amount of money printing that has occurred in a very short period of time time. And this is just one piece. This is one piece. We don't have an appropriate money multiplier today. If we just returned to, let's say, 2008 levels in terms of a money multiplier, you could take your M2 number and multiply it out to about $33 trillion in terms of a monetary footprint. John, frankly, we have already the ingredients for a super or hyperinflation. The fact that there's no indication of inflation has to do with the transmission mechanism into the economy being broken. Lending is not occurring at any real rate, and there is thus that many trillions sitting in excess reserves on bank balance sheets at the Federal Reserve, and not just our central bank, but other central banks around the world. So we're closer to a serious inflation than anyone really appreciates. In terms of tail risk, everyone has defended against and tried to cover deflation, and that's now what pundits are saying on the basis of a momentum trend. Listen, it's not that difficult to look at a trend and say gold has been down for 19 months. And for most people, you fill in the blanks like most people do. This is again, I'm not investors lack perspective. I'll just be quite frank with you. Sure. Investors lack perspective. When things are going up, they extrapolate and say they'll go up forever. When things are going down, they extrapolate and say they're going down forever. And unfortunately for the contrarian, I should say fortunately for the contrarian, that's where and how you make money. By stepping back from the crowd and saying, is there another way of looking at this? Have we checked the fundamentals of the market? And in terms of supply and demand, I think you're looking at a very healthy market. The swoon that we saw below that 1530 level in the gold price had everything to do with you could say to some degree chicanery. Technically you were at a point that needed to be held, and you had some massive liquidations come in, not of physical metals, but in the futures market. And so yes, there's been technical damage done. But I would remind you, and I would remind any of your viewers, we had the same kind of technical damage done in 2008, and we had the same kind of technical damage done in 1976. 1976, you could read any newspaper across the country, and they would have said the gold bull market is over, the dollar has stabilized, there is no inflation, all the reasons that you would want to own gold have gone away. In fact, they described in a Time magazine article in 1976, the reasons for owning gold, the luster of gold now looks more like a rusty tin can. Again, this is in 76 at gold about $105 on its way to $875. People extrapolate from, again, a short-term trend, and on a technical basis decide that they somehow have read the tea leaves and know what the future holds. You look at the fundamentals, and I think you've got a very different picture. I would suggest that by the time we hit 2016, 2017, that time frame, gold is well above 3,000, on its march higher to 5,000 at a minimum.
All right, so double down on gold. Now on the equities front, the Dow, the S&P, the Russell are all Russell 5000 are all near record highs or already past record highs. Conventional wisdom, you just talked about this, tells us that when markets or a commodity or anything hits a record high, you should start looking elsewhere for places to park your money. But what's your take? Are there still good deals out there for the value investor in equities?
Well, that last qualifier is what trips me up a bit, John, because the value investor has got to look at this and say, what am I getting for what I'm paying for? Current PE multiples of close to 18, going to be above 20 in our opinion here shortly, and that is a fairly rich multiple. And that doesn't mean it can't get richer. It just means that today you're playing a momentum game. You're playing the greater fool theory, hoping that someone else comes along and pays a higher price later on. Now, in a world of money printing, there's nothing that says that equity prices can't move up considerably from here. I would still argue we've got a 5 to 10% move. That's probably a maximum upside. But when you look at the over-under, if there's a 5 to 10% upside and 30 to 40% downside, I'm happy just to sit on the sidelines. I don't need to play. Real money can be made only when you're buying deep values. And that I think is where the contrarian would look and say, why are insiders today selling at a record rate? In January, we started the year with 1,500 shares sold for every one share purchased. Pretty high in terms of insiders. This is corporate CEOs of your Fortune 500 companies liquidating positions. The last read we had was 31,000 shares sold for every one share purchased. Insiders are saying to themselves, a bird in the hand is better than two in the bush. So I guess when you look at that, when you look at margin debt being currently about $380 billion, only equal to numbers that we saw in 2007, just before the market rolled over, and 1999, again, just before the market rolled over. People are so bullish on the stock market today, they've decided to borrow from the house, so to say, and double their position. So this is, at least for someone who's looking at some of those details, you'd say, you need to proceed with caution. And the professional investor is going to squeeze out another 5 or 10%, but the man on the street, this is where you get squashed like a bug.
Yeah, the man on the street often is left holding the bag, and the scenario you just mentioned sounds eerily familiar to 2000 and 2007. So caution, buyer beware there. Now inflation, it's been held at bay. We talked about this a little bit, but there are a lot of skeptics out there now, even within the Fed. We heard some folks pushing back against Bernanke's strategy. That includes Philadelphia's Fed chairman. He just said it's time to start tapering off these asset purchases. Do you agree with Charles Plosser? And if that happens, what does this mean for the markets?
Well, I think a taper is appropriate. I mean, I'm not sure that the kind of intervention we've seen is appropriate at all, but maybe that's a philosophical and not such a practical position to take. From a practical standpoint, the Fed and the Treasury in combination are holding the GDP statistics that we see today together. They're holding the economy together. The consumer's been absent now from the market for some time. Without the intervention that we've seen from the Treasury Department, and that being partially financed by the Fed, you'd see GDP figures 5 to 6% underwater, not 2% over or 3% over, as it's argued. So there's a significant discrepancy there, and I think it does have to do with intervention that should end. If they don't end, they're going to find it even more challenging to deal with inflation. And I think the conversation that's not being had amongst Wall Street practitioners is how much inflation is being packed into the pipeline. You know, you look at the inflation debate today, and it's chained versus unchained. The debate, academic though it may seem to most of us, they're trying to argue that inflation is not 2%, it's closer to 1.6. And again, you just go back 5 years, 10 years, 2 years. What exactly, John, is cheaper today than it was 2 years ago, 4 years ago, 10 years ago? You know, this is the reality we face. If they were counting inflation, the numbers that they have today, using the models that were used and employed by Paul Volcker, we've got 10% rates of inflation today. I think this is what most people don't appreciate. Cyprus was a one-time event, and they asked for a bail-in of 10%. Our bail-in here in the United States is the equivalent of 10% every year. Again, if you're factoring in inflation at those Volcker-type levels, they say 2, real world is closer to 10, unless Volcker was just dealing with the boogeyman in the 1970s. Maybe that's the case. Maybe there was no inflation in the 70s. But again, his model applied today, you're at about 10%. We've got a 10% bail-in program here in the United States. That, to me, is an issue.
Well, we've seen how the markets have reacted every time Bernanke comes out and says he's going to keep his foot on the gas pedal. If he does come out, and the first time he says we're going to let interest rates start creeping back up, we're going to taper off on our asset purchases, is that going to blow up the whole bubble that we're seeing right now in the markets?
I want to see what he does versus what he says, because I'm not so sure that there's not a motive towards, directing the market. He may be looking for a certain behavioral outcome from what he announces, and this is the classic job owning. He may not have to do very much. He can just sort of walk the market through the steps that he wants them to take, given an implied set of actions. So I would watch what he does more than what he says. But you are right. If there is an increase in interest rates, you're looking at major headwinds, obviously, for the bond market, consistent with what Bill Gross suggested last year, stating emphatically that the 32-year bull market in bonds is over, kaput, which would imply, certainly, that over a course of time, interest rates are going to be rising. But yes, for equities, that too, if he's going to take his foot off the pedal, so to say, then yeah, 10, 20%, I think that's what you're looking at in terms of a minimum immediate haircut in equities.
Yeah, to the average guy at home, and that includes me, who's does not come from a financial background, it sounds like alchemy to me. So we'll have to see what happens. David McAlvany, thanks for your insight. Great talking with you, and we'll talk to you again soon.
As always, John, good to be with you.
Take care.